A question that is commonly asked is, what do I do with all my hard-earned money? Now let's say you have $250,000, but you have no idea what to do with it. Finally, you decide you want to save it all, but you're a little concerned about putting all your money in the bank. A key piece of information to be aware of is how a bank actually works. Well, first you give your money to the bank in order to save it. Then the bank will use your money and give it to businesses and other people for loans. The businesses and or the other people that borrow your money will have to pay payments based on the money they borrow. Payments are given to the bank, and then the bank pays you interest on the money you have in your account. Simple enough. But what happens is the bank starts to fail and can't return all your money. You don't want to lose your money because of poor loans given by the bank. So, how do you know your $250,000 will be locked up and accessible whenever? Well, have no fear, because the FDIC is here. What's the FDIC? The FDIC stands for the Federal Deposit Insurance Corporation. Its role is to insure a certain amount of money that you have in the bank, so in the odd chance that the bank fails, your money is protected and backed by the U.S. government, and you are entitled to a certain amount of money back. Now there are a few things that you need to look out for. Not all the banks are FDIC insured. In order to find out which is FDIC insured, you can call a local bank, check the back of your debit or credit card for member FDIC, or visit fdic.gov. If the bank is not FDIC insured, then the government does not have to pay you back on the money that was lost. Now here's where the $250,000 comes along. The FDIC only insures up to $250,000 per account. So if you have more than $250,000 in an account, the FDIC will not have to insure you more than that $250,000 limit. Fortunately, there are ways of getting around this. You may qualify for more than $250,000 in coverage at one insured bank or savings association if you deposit accounts into different ownership categories, or open up different accounts and store money in the different FDIC insured accounts. The most common account ownership categories for individual and family deposits are single accounts, joint accounts, revocable trust accounts, irrevocable trust accounts, and certain retirement accounts. Now let's talk about single accounts. Single accounts are accounts that are held in one person's name only. There can be beneficiaries if the owner of the account dies, and all the single accounts at the same insured bank are added together to a total $250,000 insured. Now let's meet Jim. He's an unmarried man who owns a business called Jim's Jackets and has this $260,000 that he wishes to store in the bank. Since he's a single man and works alone, he sets up a single account for all the different areas he stores his money. Jim has 4 accounts: his money market account, his certificate of deposit, his checkings, and his savings account. But since they're all under the same bank and they're all in the same account, and they're all single accounts, the FDIC will only insure up to $250,000 worth. All of these accounts total up to $260,000, and the bank will leave $10,000 uninsured. Another account type is called a joint account. This is deposits owned by 2 or more people. If a couple has a joint money market deposit account, a joint savings account, and a joint CD at the same insured bank, each co-owner's share of 3 accounts are added together and insure $250,000 per owner. To qualify under this category, you must meet the following requirements. You must be a living person, all the co-owners must have equal rights to withdraw deposits from the account, and the co-owners must sign the deposit account signature card unless the account is a CD. There's no kinship required to have a joint account. Meet Mary and John, a newlywed couple who wishes to establish a joint account in the bank that is FDIC approved. They have $600,000 and they want to find the best way to insure their money under the FDIC. John and Mary have 3 joint accounts totaling $600,000 at the insured bank. Under FDIC rules, each co-owner's shares of each joint account is considered equal unless otherwise stated in the bank's records. John and Mary each own $300,000 in the joint account category, putting a total of $100,000, $50,000 for each, over the insurance limit. But with a joint account, they are able to insure more than $250,000 because of the FDIC approves $250,000 per person. Continuously, the FDIC will insure more than $250,000 in a revocable trust account. A revocable trust account is an account, a deposit owned by one or more people that identifies one or more beneficiaries who will receive the deposit upon death of the owners. It can be changed by the owner at any point in time, and there are two types of revocable trust accounts: the informal revocable trust account, which is often called the payable on death account, and the formal revocable trust account, which is known as a family trust or living account. The difference is that the owner controls the deposits and the other assets during his or her life, as opposed to the bank dealing with it. In order to insure more than $250,000, you need the beneficiaries to meet the requirements, or the money is not insured. The requirements are the beneficiaries must be in the record of the bank, beneficiary must be a living person or charity, and the account must be pursuant to a trust relationship. You can have up to 5 unique beneficiaries, and the FDIC would still insure you for $250,000 each. Now this is Dennis. He's a married man who has a nice family and $500,000 worth of savings. He's a wife named Janet and a son named Jack. After he had his son, he decided to make 3 revocable trust accounts at the same insured bank. He decides to have an informal or pay on death account under one owner. When depositing $500,000 worth of savings, he names 2 unique beneficiaries. Since he has named 2 unique beneficiaries, each is insured for $250,000 per person, and it makes it so all the money is insured. In the next scenario, there's a couple named Paul and Lisa. They have 2 kids, Sharon and Michael, and Lisa has a brother named Dylan that lives with them. Paul and Lisa decide to open a revocable trust account together and have it under 2 owners. Paul and Lisa have a lot of money that they wish to be insured, so they decide that they will combine their accounts into one family trust account, naming their 2 kids as beneficiaries. But Lisa has some money that she thought should go to her brother Dylan. So she decides to open a POD account with some of her money, and she named her 2 kids and her brother Dylan as beneficiaries. Paul shares 50% of account 1, which is a $350,000 share. He's insured for $500,000 because of the 2 beneficiaries. Lisa has $800,000 share because of her 50% owned in account 1 and her 100% owned in account 2. Since she has 3 unique beneficiaries named, she is only able to insure $750,000 of the $800,000. But in total, they are able to insure $1.1 million. The FDIC provides other insurance policies under different ownership and different accounts, but most of them only insure up to $250,000. Other accounts include certain retirement accounts, irrevocable trust accounts, government accounts, and more. From what I've been telling you so far, each family has been able to insure all or most of their money under one account. What happens if all the accounts were combined in such a way to insure all your money? Here, there's a family of a husband, Daniel, a wife, Lori, and 2 kids, Jeffrey and Christina. Their family has a net worth of $3 million, and they are able to insure every penny. By dispersing their money in different accounts, they are able to insure $3 million altogether. This family used all the different accounts to insure their $3 million. Daniel has a single account which insures him up to $250,000. Then Lori has a single account that insures her up to $250,000. And both Daniel and Lori have IRAs, which is a certain retirement account which insures them up to $250,000 each. Daniel and Lori also put some of their money into a joint account which insures them a total of $500,000, and the rest of the money is set aside for revocable trust accounts. As you can see, there are 2 revocable trust accounts that are set up as PODs, in which there is only one beneficiary, and the final account is set up as a living trust with 2 owners and 2 beneficiaries, which is a total insure them up to $1 million. In total, there is $3 million that is insured by the FDIC after the money has been split up into different accounts. I know this is a lot of information and a ton of different accounts and different ways to insure your money, but I hope this at least in some way helped you to understand what you can do to make sure your money in the bank is insured and backed by the FDIC.